For decades, the international pricing of gold and silver has been orchestrated not by the free-flowing fundamentals of physical supply and demand, but through a sophisticated system of paper derivatives traded on major Western exchanges, primarily the COMEX in New York and the LBMA in London. This system functioned as a form of legalized price management designed to suppress the value of these monetary metals relative to fiat currencies. However, the events of 2024 and 2025 revealed critical fractures in this mechanism, suggesting a profound and potentially irreversible shift in the global monetary landscape. The architecture of control, how price suppression worked at the cornerstone of this system, was extreme leverage. The physical metal held in exchange vaults served as a tiny foundation for a vast pyramid of paper claims. Analysts like Matthew Piepenburg have highlighted ratios where for every 1 unit of physical gold, there could be 50, 80, or even 96 units of paper gold futures, options, swaps traded. This created an artificial overhang of supply that consistently pressured prices downward. The process was sustained daily by a handful of major banks conducting paper shorts against the physical market. When this paper leverage was threatened typically by rising prices that hinted at real demand, the exchanges had defensive tools. 1. Margin hikes, the most common tool. By suddenly increasing the collateral margin required to hold a futures contract, exchanges could trigger forced liquidations. Speculators and hedge funds unable to post more cash would be automatically sold out, creating a wave of selling to drive the price down. This was not risk management, but a deliberate tactic to purge bullish speculators. 2. Position limits and limit orders. Exchanges could impose rules limiting how much any single entity could buy, effectively capping demand. 3. The nuclear option, sell-only markets. In a worst-case scenario, an exchange could suspend buy orders altogether, allowing only sales to flood the market and crash the price. This regime worked seamlessly as long as two conditions held. First, that very few market participants ever asked for physical delivery of the metal behind their contracts, and second, that global above-ground inventories were perceived as plentiful. The breaking point, 2025, and the physical delivery crisis paradigm began to unravel as structural demand overwhelmed the paper facade. Central banks, led by nations like China and Russia, embarked on historic multi-year gold accumulation programs. Simultaneously, the energy transition and technological boom, electric vehicles, solar panels, AI hardware skyrocketed industrial demand for silver, a metal already facing years of structural deficit. The crisis manifested into clear events. 1. The gold delivery run. Throughout 2025, the COMEX witnessed an unprecedented exodus of physical gold. The standing for delivery metric, which measures those demanding actual metal, soared from a traditional 1 to 2% to a shocking 100% at points. This meant every ounce of new gold arriving was immediately claimed and withdrawn. The paper pricing mechanism, built on the assumption that metal would stay put to be rehypothecated, began to lose its anchor. 2. The silver squeeze. The situation was more acute in silver, where above ground, readily deliverable inventories are far smaller. The London market effectively seized up. Excuses about logistical issues, trucker shortages, bar weight were widely seen as a smokescreen for a simple truth: the vaults could not meet delivery requests. The reported global deliverable float was astonishingly small, leaving manipulative tools useless against genuine demand. In December 2024, a desperate margin hike on silver futures failed spectacularly. While it forced out leveraged speculators and briefly crashed the price, it did not scare away the ultimate end users. Companies like Tesla and Samsung, needing silver for production, saw the price drop as a buying opportunity. This revealed a fundamental truth: you cannot manipulate away a physical shortage with paper tricks when the core demand is industrial and monetary, not speculative. Consequences and the emerging new system failure of these tactics signals a historic transition with several key implications. Loss of Western pricing hegemony. The COMEX and LBMA are losing their teeth. Their power was derived from the perception of infinite liquidity through paper contracts. As that credibility erodes, price discovery migrates to where physical metal can be reliably delivered. Exchanges in Shanghai, Singapore, and potentially St. Petersburg are positioned to gain influence by offering physically settled contracts and transparent vaulting. If Western exchanges resort to extreme measures like sell-only rules, they will simply accelerate this capital flight east. Investment implications: physical over paper. For investors, this underscores the critical distinction between paper claims on metal ETFs, unallocated accounts, cash-settled futures, and physical metal itself. The 2025 events were a stark lesson in counterparty risk. The new CME 100-ounce cash-settled silver contract, launched amidst this stress, is seen by analysts not as innovation, but as an admission that facilitating physical delivery is problematic. The strategic move is toward assets with verifiable physical backing, allocated metal, sovereign coins, and shares in miners with proven reserves. A monetary regime change, not a bull market. This is more than a commodity cycle. Rising gold and silver prices are a symptom of a collapsing faith in unbacked fiat money. With global debt exceeding $300 trillion, systemic monetization QE, deficit spending, is a mathematical certainty, leading to the continuous debasement of paper currency. Gold, as the ultimate neutral asset outside the banking system, is reasserting its historical role as money. A 70% annual gain in gold is not mere speculation. It is the market pricing in a century of compounded monetary inflation and declining trust. Navigating the future, volatility, and conviction this transition will not be smooth. History shows that during such secular bull markets, like 1971 to 1980 violent retracements, gold was kneecapped in 1975 are common and designed to shake out weak hands. Similar sharp pullbacks in gold and silver are likely, potentially triggered by a broader equity market correction. However, the context is crucial. The real risk is being absent from this asset class altogether during a fundamental remonetization of gold within the international financial system. As Matthew Piepenburg's analysis concludes, we are witnessing the end of a decades-long era of price fixing and the painful, volatile dawn of a new monetary order, where physical scarcity and sovereign demand will dictate value, not paper leverage created by a few privileged banks. The rules of the game have changed.